Hello friends, welcome back to Accounting Standard 23, Accounting for Investment in Associate in Consolidated Financial Statement. We'll come to question number 2 now. Question number 2, ABC holds 25% share in PQR at a cost of rupees 10 lakh. These investments were acquired for 10 lakh. There was no goodwill or capital reserve at the time of acquisition. So the problem is saying there is no goodwill or capital reserve at the time of acquisition. You are not required to prepare this working note on goodwill or capital reserve. The total share capital of PQR is rupees 40 lakh. So if you take 40 lakh into 25%, it will come to 10 lakh only. And if you compare cost with net asset 10 lakh, goodwill is 0. And for the current year, it has made profit of 6 lakh, out of which dividend at 10% of the share capital has been paid. Dividend has been paid. Find out the amount to be shown in the consolidated financial statement as an investment in associate. So in this question, what I'll do, on the asset side, we will have non-current asset, and under that we will have investment in associate. The question is how much amount we will put. So we'll put a working note. In working note, cost of acquisition is 10 lakh. Cost of acquisition, first line 10 lakh. Then you will add share in profit of associate. You will add share in profit of associate. The problem says over here 6 lakh rupees profit was made. So your share in profit is 6 lakh into 25%. That is 1,50,000. When the associate makes profit, the net asset increases less. But when the associate pays dividend, the net asset of associate decreases. So we are going to reduce the carrying amount of investment. Less dividend received. Dividend received will be, total dividend paid is 40 lakh into 10%. This is the dividend paid by associate, total 40 lakh share capital at the rate 10%. But ABC Limited will receive only 25%. So that is 4 lakh into 25%, 1 lakh. And therefore, the carrying amount at the end of the year should be 10 lakh 50,000. This is how the student should prepare the answer. Okay, any query on this? You can check the answer printed in the book also. First you take 10 lakh, add 1,50,000 minus 1 lakh, carrying amount 10 lakh 50,000. Then we'll go to question number 3. We'll go to question number 3. XYZ Limited acquired 30% equity share capital of Dev Limited at a cost of 6 lakh. So the cost is 6 lakh, underline, share in net asset is 30%. You have acquired 30% stake. With 30% it is an associate. On the date of acquisition, the balance sheet of Dev Limited shows the following. So this is the balance sheet on the date of acquisition. This is net asset or equity on the date of acquisition. If you multiply by 30%, that will give you share in net assets. So 10 plus 3, 15 lakh into 30%, 4,50,000. 6 lakh minus 4,50,000, 1,50,000 will be goodwill. At the time of acquisition, we have to compute goodwill. 6 lakh minus share in net asset, 4,50,000. Then since then they had made a profit of 2,50,000 and has declared and paid a dividend at the rate 15%. Same problem, this part. Only in this question goodwill is required. Find out the amount at which investment in associate will be shown in the consolidated financial statement. So here what we'll do, first step will be calculation of goodwill, and for that we have to simply write point A, cost of acquisition, which is 6 lakh, and point B, share in net assets of associate on date of acquisition. Share in net asset of associate on the date of acquisition, that will be 30% of 15 lakhs, 4,50,000. So point C, you will have goodwill 1,50,000 goodwill, 1,50,000 goodwill. Then the next step is to find out the carrying amount at the end of the year. Carrying amount at the end of the year. So you have cost of acquisition 6 lakh. You have cost of acquisition 6 lakh. Then this associate has made a profit of 2,50,000. Add share in profit of associate. You have 30% holding into 2,50,000. That will be equal to 75,000, and minus you have received dividend. Dividend received will be, the total share capital is 10 lakh. Dividend is paid at the rate 15%, and your share in that would be 30%. 10 lakh into 15% into 30%, that is 45,000. And therefore the carrying amount will be 6 lakh plus 75,000 minus 45,000 is 6 lakh 30,000. And then the presentation in balance sheet. Presentation in balance sheet extract. You will write asset side, you will write non-current assets, you will write investment in Dev Limited, which is an associate, 6,30,000, and you will write a note in bracket, includes goodwill, rupees 1,50,000, includes goodwill rupees 1,50,000. The last line is includes goodwill rupees 1,50,000. And this way the student should present the answer in the exam. First compute goodwill, carrying amount, and how the investment will appear in the balance sheet. That was my question number 3. Now come to the institute answer. They have presented like this. First they have computed goodwill, Then they have computed the carrying amount 6,30,000. Now we'll go to question number 4. Parent Limited acquired 25%. Parent Limited acquired 25% share of Associate Limited at a cost of rupees 30 lakh. Same discussion, 25% stake, 30% is the cost. On this date, the equity share capital of Associate Limited was 1 crore 20 lakh and the accumulated reserve is 10 lakh. So this is net asset on the date of acquisition. Total will be 1.30 crores. Thereafter, Associate Limited incurred a loss of rupees 60 lakh in the first year. First year loss 60 lakh. Calculate the share of loss of investor, reduce it from carrying amount of investment, and a loss of rupees 80 lakh next year. Similarly, calculate the share of loss in the second year, reduce it. Find out the amount of goodwill or capital reserve. That we can do. How the investment in associate will be shown in the consolidated financial statement in the next 2 years. So we have to prepare the balance sheet for next 2 years. How do you proceed with such question? First you should compute goodwill, because they have asked you, or capital reserve. Goodwill or capital reserve. Under that we need to write cost of acquisition, which is in the given in the first line, 30 lakh. This is cost of acquisition 30 lakh less share in net assets of associate. Share in net asset of associate, which is again 25% into 1 crore 20 lakh is share capital and 10 lakh is the reserve. 1 crore 30 lakh into 25%, it is 32 lakh 50,000. So this time we are getting capital reserve. I have given the answer in your book. You can later on solve in the notebook on your own. Right now the student will only concentrate on understanding part. Capital reserve 2,50,000, cost of acquisition is less. Now we'll come to step 2, carrying amount. Carrying amount at the end of year 1. Carrying amount at the end of year 1. So we have cost of acquisition 30 lakh, in bracket includes capital reserve, includes capital reserve 2,50,000, and then you will write less share in loss. Share in loss, first year loss is 60 lakh. 60 lakh into 25%, that is 15 lakh. So balance is 15 lakh. First year balance will be 15 lakh. First year balance will be 50 lakh. Step 3 will be carrying amount at the end of year 2. carrying amount at the end of year 2. Now here I will first write opening balance. Opening balance will be 15 lakh, includes capital reserve, 2,50,000, less share in loss. Oh, this time the loss is 80 lakh into 25%. 80 lakh into 25%, 20 lakh. Now, what amount you will write in the outer column? Nil. Why nil? Because we have studied that if after adjusting the share in loss, if the balance becomes negative, you will record nil amount. You can show negative amount only if the investor has undertaken an obligation or has given guarantee or has made payment on behalf of the associate. If nothing is given, if the balance is negative, I will say carrying amount will be nil and I will write a note for that. So that note is printed in the book below the second year. You can copy that note from there. So what do you do? First step in your exam would be to find capital reserve. Second step in your exam would be to find carrying amount at the end of year 1. Third step in your exam would be to find carrying amount at the end of year 2. I have written everything. You have to concentrate on understanding, and after year 2, because you are not writing negative 5 lakh, you need to write a note. And what is the note you will write? If under the equity method an investor's share of loss of an associate equals or exceeds the carrying amount of the investment, the investor ordinarily discontinues recognizing its share of further losses and the investment is reported at nil value. So this first note you will write. Second note you will write below, additional losses are provided for to the extent that investor has incurred obligation or made payment on behalf of associate to satisfy the obligation of that associate that the investor has guaranteed or to which investor is otherwise committed. So this note you have to write in case if you are getting a negative balance but you have taken 0 value. We'll go to question number 5 now. Question number 5, another important question. Big Limited has 2 subsidiaries. These are subsidiaries, mini and small. It will not affect my answer. It is a listed company and prepares consolidated financial statement. So the requirement of this chapter is that the entity should be preparing consolidated financial statement. In order to have significant influence over financial and reporting policies, Big Limited acquired 22% control of Groupsoft Limited. So this time the stake is 22%, total share capital is 20 lakh at a cost of 6 lakh. This is the cost, this is the net asset 20 lakh. There was no accumulated profit or reserve losses on the date of acquisition. So their balance sheet has only share capital, doesn't have reserve. So this 6 lakh and 22% of 2 lakh will be required for calculation of, yes, calculation of goodwill or capital reserve. So my first task will be to find goodwill or capital reserve based on this information. Second task, during the next 2 years of operation, Groupsoft Limited incurred total operating losses of 30 lakh. So in the next 2 years, associate loss is 30 lakh. Show the investment in associate in the consolidated financial statement of Big Limited. Again, the presentation is to be given in consolidated financial statement. When? Immediately after acquisition in Groupsoft and second after the 2 years of operation. So first we will see calculation of goodwill. Very easy. First step is calculation of goodwill. Answer is given to you. You just have to observe and understand. So how do I compute goodwill? I compare cost of acquisition 6 lakh with the share in the net asset of the associate on the date of acquisition. So this associate has only share capital, it doesn't have reserve. So the net asset will be equal to 20 lakh. You have acquired 22% share. Share in net asset of the associate on the date of acquisition is 4,40,000. Compare 6 lakh with 4,40,000 and you will get goodwill is equal to 1,60,000. So we have to identify goodwill on the date of acquisition and disclose it separately. So how my balance sheet on the date of acquisition look like? That is my first question. Consolidated balance sheet on the date of acquisition would look like this. Asset side, non-current asset, right here asset side, non-current asset, it will be shown in non-current asset. Investment, under that investment in Group Soft Limited, associate company with a disclosure about goodwill, includes goodwill 1,60,000 and the amount is 6 lakh. The amount is 6 lakh. This is on the date of acquisition. How will the balance sheet look like? Consolidated financial statement look like? Consolidated financial statement look like, instead of CFS you write here balance sheet. How consolidated balance sheet look like after 2 years? We had made an investment at a cost of 6 lakh, which includes goodwill of 1,60,000. But during next 2 years, there was a loss incurred by the associate, 30 lakh. And we have 22% stake, therefore it is 6,60,000. 6 lakh minus 6,60,000 is negative, but I will not take negative number. I will write nil here and I will write a note which is already printed in the book. Same note copy from question number 5. Same note copy from question number 5. Okay. Now we'll come to question number 6. Very important question number 6. Write down, very important. Question number 6 is Publishers Limited acquired 30% equity share capital. So the stake acquired is 30% of Bookland Limited at a cost of 4,50,000. At a cost of 4,50,000. 30% stake, cost of acquisition 4,50,000. The comparative balance sheet of Bookland Limited on the date of acquisition is given below. Okay. So now in this question there is a small typing mistake. Share capital is 10 lakh. Take a pencil, match 10 lakh. General reserve is 2 lakh and 2,30,000. Securities premium 1 lakh and 1 lakh. Current liabilities is 1,50,000 and proposed dividend at the end of the year is 50,000. So the students are requested to match the figures with the description. There is one line misalignment. Asset side is okay. Fixed asset, investment, current asset. This is the balance sheet of Bookland Limited. Who is Bookland? Associate. Instead of giving you the figures of profit and reserve directly, the student will have to find it out. Okay. So on the date of acquisition we have share capital 10 lakh, general reserve 2 lakh, securities premium 1 lakh. So that will give me the net asset on the date of acquisition. Share capital, general reserve, securities premium. If I add these three numbers, that will give me net asset on the date of acquisition. Okay. Or what you can do, you can take the total of the asset 14,50,000 minus current liability 1,50,000. 14,50,000 minus 1,50,000, 13 lakh. Even that way you can compute net asset on the date of acquisition. Now the next task is to find out the current year's profit. How do I find current year's profit? How do I find current year's profit? Share capital has not changed. Securities premium, general reserve, this is general reserve. General reserve has increased from 2 lakh to 330. So increase in general reserve is due to transfer from profit and loss account to general reserve. Securities premium has not changed, no problem. Current liability, no problem. But proposed dividend during the year created is 50,000. So current year's profit will be equal to sum of two numbers. One is increase in general reserve, that is 3,30,000 minus 2 lakh. This is a hidden adjustment and some students may not be able to understand how general reserve has increased. P&L account debit to general reserve. This way general reserve increases. How proposed dividend appears in the balance sheet? P&L account debit to proposed dividend 50,000, 50,000. But P&L account is not in the balance sheet, which means whatever profit they have earned, they have either transferred to general reserve or they have made provision for proposed dividend out of it. So total profit for the year will be how much? 1,30,000 transferred to general reserve and 50,000 transferred to proposed dividend. So hidden information is current year profit. Current year profit is 1,80,000. Current year profit is 1,80,000. So this is the information we got from the balance sheet. Now the question is, there was no revaluation of asset by Bookland. Very good. Current asset of Bookland Limited at year end includes stock costing 60,000, purchase from Publisher Limited. So this is a transfer of stock from publisher to Bookland, and therefore there is an unrealized profit which sells at cost plus 20%. So you need to compute unrealized profit 20 by 120 because it is cost plus 20% into 60,000 and your share is 30%. So multiply by 30%, and to the extent of unrealized profit, investment carrying amount will be reduced. Share in profit, add. Unrealized profit, reduce. Show the investment in associate in the consolidated balance sheet to be prepared by Publisher Limited at the beginning, again 2 times, and at the end. So what will be my first step? My first step will be to find out goodwill or capital reserve. question in front of you, answer is already printed, you can only understand you can focus on understanding right now. And as a homework, solve in notebook. A good student, if you are really thinking that you are a good student and you want to come in merit, you want to pass in the first attempt, you want to make your parents proud, all these questions you must do in the notebook. Okay, all these questions you must do in the notebook. So I will first write cost of acquisition. These questions are not in the study material. Question 1, 2, 3, 4, 5, 6 we have taken are not in your institute material. We have taken efforts to bring it for you from so many other reference books, so that you will have ample practice. So what you can do in return, you can solve in the notebook on your own, that much you can do. So you will have to first find out cost of acquisition, then equity or net asset on the date of acquisition, share capital plus general reserve plus securities premium 13 lakh. What is your percentage holding? 30%. Share in net asset on the date of acquisition 3,90,000. Therefore goodwill 4,50,000 minus 3,90,000. Goodwill will be 60,000 rupees. This is for disclosure purpose under AS 23. The question is how the balance sheet would look like at the beginning. Consolidated financial statement of Publisher Limited at the beginning. Asset side, you write here non-current asset. Under that investment in Bookland Limited associate cost 4,50,000, and you will write as a disclosure includes goodwill of rupees 60,000. Now we'll come to the second working note, which is very important, something new for you. How much profit did the associate make in the first year after acquisition? So for that we will have to look at the general reserve figure. It was 2 lakh, now it is 2,30,000. So general reserve has increased by 1,30,000, and then we have to look at the proposed dividend, which was 0 and now it is 50,000. So during the year they must have debited the P&L account and credited general reserve and credited proposed dividend. So total profit of the year is 1,80,000, and the share of Publisher Limited out of that would be 30%, which is 30% of 1,80,000, and it comes to 54,000. Now there is an unrealized profit on stock adjustment also. This now they have added in the problem. So what do I do? Unrealized profit is equal to, first we'll compute unrealized profit, which is 20 by 120 into 60,000, 10,000, and Publisher Limited is holding 30% share. So Publisher Limited share would be 30% into 10,000, which comes to 3,000. Okay. Now how the balance sheet would look like at the end of the year? CFS of Publisher Limited at the end of the year. Asset side, non-current asset. Non-current asset, so we will have investment in Bookland Limited, in bracket including goodwill of 60,000, 4,50,000 plus you will add share in profit, which we have computed 54,000. Draw a line, take a total 5,04,000, and this unrealized profit will be deducted. Less share in unrealized profit on stock 3,000. 3,000 you deduct, this 3000 should be written here in bracket, and therefore the balance will be below 5,01,000. This will be the answer. The answer is over. But the student can have a question, why we have not adjusted the proposed dividend. Proposed dividend is not yet paid. Unless proposed dividend is paid, it will not reduce the net asset of the associate. Okay, and hence we are going to adjust dividend from associate only on receipt basis. We are going to adjust dividend from associate on receipt basis. So that was my question number 6. Any query? No queries? If you have a query, you will mail me at vinod_ca@yahoo.com. You can send WhatsApp on 97669 So if you have doubt on any of these questions, you can ask the doubt, but please mention your name, your subject, your topic, question number, page number, and the photo of the question and the answer. Easy for us to immediately provide you the reply. Now we'll go to question number 7. Again, very important, taken from reference book. Question number 1, 2, 3, 4, 5, 6, 7 we have taken from reference book. Your study material does not have sufficient number of questions, but for exam's sake you need to prepare more. Question number 7, H Limited has a 100% subsidiary and is required to prepare CFS. So this company prepares CFS. It holds 35% equity share capital of X, which is classified as an associate. All the three companies usually transact in the sale and purchase of the goods from one another. While preparing the consolidated financial statement, the following information has been extracted. First is, stock of X Limited includes goods of 25,000 purchased from H Limited, which sells goods at cost plus 25%. Stock of H Limited includes goods of 36,000 purchased from X, which sells goods at cost plus 20%. So you have to compute unrealized profit on this. When the profit margin is given on cost, you will take 25 by 125 into 25,000. So unrealized profit 5,000. 20 by 120 into 36,000, that is 6,000. So total unrealized profit is 11,000. Share of H Limited will be 35% of 11,000, and that comes to 3850. That comes to 3850. Find out the amount of unrealized profit to be eliminated from consolidated balance sheet. The answer is 3850. Also record the journal entry. So journal entry would be consolidated P&L account debit 3850 to investment in associate 3850. Profit will reduce by 3850. Investments carrying amount will reduce by 3850. The answer is given in the same way I have explained. First you compute unrealized profit, okay, on first transfer, then you compute unrealized profit on the second transfer. Take the total 11,000, take 35%, 3850, and pass journal entry. Okay, this is how you will solve question of unrealized profit for AS 23. Now come to question number 8. Question number 8. ABC and XYZ are independent companies and having no corporate relationship. In the beginning of the current year, ABC has purchased 65% share capital of XYZ. So originally they have purchased 65%, thus making the latter to be a subsidiary. So initially the relationship was parent and subsidiary. However, under the memorandum of understanding, there is an agreement that ABC will offer 45% share of XYZ to public after the after which effective holding of ABC will be reduced to 20%. So first they will acquire 60%, then sell 45%, now holding 20%, which is considered to be sufficient for exercising significant influence. And now you are having significant influence. The disinvestment plan was implemented in the same year. So the 45% was sold in the same financial year. How should ABC treat the investment in XYZ at the end of the year for the purpose of preparation of CFS? So the answer will be, it will be treated as associate, because now you are holding 20% share and you are able to have significant influence. So the treatment for the XYZ in the books of ABC would be, it will be now treated as associate. You are able to exercise significant influence, and which standard will be applied for the purpose of accounting of investment in associate? AS 23. AS 23 would be applied. Okay. Question number 9 from your study material. A Limited acquired 25% share in B. A Limited acquired 25% share in B. Date underline on 31st March 2002 for rupees 3 lakh. The balance sheet of B is the associate, on 31st March 2 is given below. So this is the balance sheet on the date of acquisition. You have 5 lakh share capital, 5 lakh reserve. So total net asset is 10 lakh, and you have acquired 25% of that. Then during the year ending 31st March 3, after 1 year, look at the date, it is after 1 year. The following are the additional information available. A Limited received dividend from B Limited for the year ended 31st March 2002 at 40% from the reserve. Dividend was received for year ended 31st March 2002. Date of acquisition is also 31st March 2002. So this is called dividend out of pre-acquisition profit. This is called dividend out of pre-acquisition profit. AS 13 will apply, and according to AS 13, it should be credited to investment account. Dividend received out of pre-acquisition profit should be credited to investment account, and investment account balance will reduce. So let us understand how much dividend, how much was your cost of acquisition. First line of the question, we are discussing this adjustment 1. Cost of acquisition 3 lakh less dividend out of pre-acquisition profit is 50,000. So my revised cost of acquisition will become 2,50,000. This is adjustment as per AS 13. As per accounting standard 13. This is not as per AS 23. First adjustment is as per AS 13. So I will first revise it to 2,50,000 and then I will apply further calculations. Now it says B Limited made a profit after tax of 7 lakh for this year. Add share in profit. B Limited declared a dividend at the rate 50% for the year ended 31st March 2003. It is declared, not paid, on 30th April 2003. This will not be adjusted because dividend is only declared, but dividend was not paid by 31st March 2003. Dividend was paid on 30th April. So proposed dividend is not adjusted. This will not be adjusted. This is given to test you. This company is preparing CFS. If it is preparing CFS, AS 23 is applicable. Calculate goodwill on acquisition. How do I compute goodwill? I will take revised cost of acquisition. 2,50,000 less share in revised cost of acquisition will be taken because cost of acquisition will reduce because of pre-acquisition dividend. Less share in net assets on the date of acquisition. So I'll go back. On the date of acquisition, share capital plus reserve is 10 lakh into 25%. This is 2,50,000. So the answer is 0 because there is no difference. Difference is 0. So in this question, goodwill is 0. First answer, goodwill is 0. Second answer, how will A Limited reflect the investment in the CFS? So my cost of acquisition is 2,50,000 after adjusting pre-acquisition dividend, and I will add share in profit. So first answer is goodwill. Please check. Goodwill calculation, please check. You need to revise the investment cost, then compare with share in net asset. And now my question is how the investment would look like for the year ended 31st March 2003. Cost of acquisition I will take would be the revised one, 2,50,000, which includes goodwill of 0 and share in profit of B Limited 7 lakh into 25%, that is 1,75,000. So my closing amount will be 4,25,000. What about dividend? Dividend which was received in the current year was dividend out of pre-acquisition profit, so that will be reduced from investment we have done. Dividend which is declared or proposed but not paid by the end of the year 31st March 2003 will not be adjusted. Dividend proposed will not be adjusted. It will be adjusted when the dividend will be paid by B and received by A. Okay. So I have solved 9 questions. You will try the other questions also. Okay. Thank you very much. Try the other problems also.